Hello guys, this is Victor Snow from Trading from the Soul. I'm here today to teach you guys the concept of a fair value gap. So how does the market even move at all? We see that the market actually moves from a discounted level to a premium level, and once it gets to a premium level, it starts seeking for a discounted level immediately, and once it gets to a discounted level, it starts seeking for a premium level, which we can otherwise call a correction and impulsive move. And we see that when market does this for us, market creates imbalances for us. Imbalances right here for us. These imbalances are otherwise known as a fair value gap, and this concept of fair value gaps, that's what we are going to be learning in this YouTube video, what it is, the 3 rules to spot them correctly in the market. And I want you to stick to the end of this particular YouTube video, because by the end of this YouTube video, I'm going to be giving you a 60% 5RR US tactic trading system. You are going to love this. So guys, I'm actually Victor Snow. For those of us who know here, I trade the Euro USD, US30, GBP USD, USD, CHBY, and I'm someone that have backtested this trading system for 25 years, and I can proudly say I have a 70% personal win rate and 3RR risk to reward ratio. I was able to throw out 2,500 trades from my system. So guys, what was even a fair value gap? We say that a fair value gap is a price jump without retracement, and this is as a result of so much orders coming into the market almost at the same time that the market would kind of forgot to retrace back and left unfilled orders there. Where does this actually occur? This actually occurs during news, or most times during when institutions actually participated in the market in this scenario. So guys, how do we actually spot this? I think the number one place to start looking out for these guys is the recent place institutions actually move the market, which is the recent imbalance, which is actually this zone, and other block, which I taught you in another video, break of market structure and other block. The first rule is for a bullish fair value gap, we say that it is the first candles. You pick a first candle, your own first candle, week high, first candle's high, and the third candle, you pick your third candle. This is our third candle, the third candle is low. Can we, and you mark it out, can we actually see a fair value gap here? Yes guys, there's a fair value gap. So another rule here is not minding the candle's color. It means that the third candle can actually be a bearish candle. So the question here is, are there some fair other blocks or zones without the fair value gap? Yeah. Let's take example for this zone. Now can we see that there is not a fair value gap here? There is no fair value gap in this whole move up. Let's see now. This is our first candle high, and this is our third candle low. Is there a fair value gap? No. I'm gonna pick this one and this one. Is there a fair value gap? Pick this one and pick this one. No. In spotting a bearish fair value gap is almost the same rules. First rule is start looking at it from the recent place institutions participated in the market, which is an order block. This is our order block already mapped out here. Then we start looking at it now. So the rule actually here is the first candles high and the third candles low. Can you see this is the opposite of the other one, the bullish fair value gap? So this is our first candle, and the first candle here, and this is our high now. This is the low and this is the high. So the high here, pick it, and this is our third candle, the low here. You find a box to map it out, and guys, this is our fair value gap right here. So guys, I believe the story behind this is a whole move to the downside. So let's take here is our daily time frame. If you go to the lower time frame, this candle you're seeing here is actually a move downwards. Then this week's right here you are seeing here, this week's you are seeing right here now, actually the market this particular week now is the market retracing back in the lower time frame. Then this candle here, the next candle is a move downwards. The candle, the week there is market retracing back. And when market go to a certain higher time frame level, market started to institutions entered and started to move price upwards, and we started moving to the upside, something like this. Impulsive move correction. So this gap here means that there were so much orders right here to move. Remember I told you the orders now to move the market so much that the market forgot to actually come back here for infilled orders now to go up, which the market will tend to come back for it. And the way I used to explain this to my students is I normally say a path to success is actually not a straight line. So as the market is actually not a straight line. The market don't move in straight line. So believe that the market actually moves in waves, which we will have an impulsive move, a correction, an impulsive move, a correction. So as the road to success is filled with ups and downs. Your ability as an entrepreneur or as a trader, when you are down to this level, to realize and tell yourself that there is always an up to rise up to, is what you should always crave for. So in our market scenario, the institutions will always try to move. Once market gets to a premium level, the institutions will try to move price to come back and collect in-field orders here that they forgot to collect. So what go hold? This is just a cycle in the market and real life scenario. So smash the subscribe button and hit this video right here to learn more about it. Guys, using what we just learned here, let's see whether we can be able to spot this in our chart. So the rule here is what? Find an order block. The first place to start looking at it is an order block, which we can mark out this one as an order block, which I taught in other video. Marking out the fair value gap, you actually from this level, you start looking at it from there. And our fair value gap is this level. Break of market structure. Is there a fair value gap here? No. Another break of market structure. Is there a fair value gap here? Yeah. Remember I told you not minding the candles color. Let me get it closer so you guys. Not minding the candles color. There is a fair value gap here to here. So we want to just go around and mark out these whole zones for me. So using what we learned, how can we be able to trade these fair value gaps right here? Which strategy? This is 60% win rate strategy that I talked about in the beginning of this video. Actually writing a strategy, trading strategy, what you need is a higher time frame direction, a higher time frame zone, which in our higher time frame direction right here, we also we can see that we broke market structure. The market is actually bullish. Then our higher time frame zone is when this fair value cap comes in, not an order block. This fair value cap comes in, it's gonna be our zone, and that is the zone we are only gonna be trading. So what we are expecting from here is market was coming down. Market was coming down, a switching trend like this. Then any of the recent fair value gaps is our zone. So our high time frame direction is uptrend. Any of the fair value, we might get one here. The recent fair value is our zone. We can have more than it. In this scenario, you can see we have this is our order block level. Let me recolor it so that you understand what I'm trying to say. Let me recolor it. This is our order block level here now. Our fair value gap is here. We have another one around here to here. We mark them out and see the market's reaction to each and every one of them. But we pay close attention in this strategy to the most recent one. So at this level, our most recent one is definitely this level in the market. So what most traders do is they tend to just put an order, put stop loss here. Yeah. So, another thing most traders do is they want market to break and they'll start selling. We are not doing this right here. No break off, no BC, something here. Thing is, once it comes to here, we are buying. If it breaks, we are not buying, we are not selling until market breaks this low here in the market. So we want market to come back to this our zone now, and we'll move to our lower time frame for what I call a 1 hour displacement. So once market, this is around here, is when we actually retested. When market actually go to this our 1 hour zone, now fair value gap right here for us here now, we wait for a 1 hour displacement, which displacement is something like this. And you come back here now, and we use our fib from Fibonacci retracement level. So we'll draw your Fibonacci retracement level from the low here to the highest market I've been to. We're going to be putting our entry signal level from here 0.618. Stop loss below this fair value gap, 2 pips. Here 200 points below this fair value gap zone, and we target was just a 5:1 ratio. And as you can see, the market actually went more than 5:1 ratio. That's what I do. Last trade I posted on my Telegram group, we did more than 5, 6, 7 ratio, but I actually took 3:1 ratio. If you understand your system, you tend not to be greedy or take more from the market. All you need is a consistent something that the market gives you. So don't tend to be greedy. Just 5 is okay. So in this scenario, 5:1 ratio. So what's this displacement I'm talking about? I think we have different types of displacement, which I normally teach my students. First displacement we're going to be learning in this video is what I call a cash trap displacement. When market actually came back here now, that's the first one I actually taught you guys now. Market was not, some people will call this a traditional double bottom. Market was coming back, come here now. Whatever you choose to call it, but I've just wait for market to let there be a break of market structure around this zone here now. And it tends to take your fib the same way, draw from the lowest point market I've been to the highest, and we'll be entering from this zone this zone, stop loss 2 pips below the fair value gap zone. Take profit 5 RR. Another type of displacement we're going to be looking at is actually this type. I think this is almost the same thing with this one that we learned here. Market came, retrace, boom. And these people will call this a traditional W pattern. Can you see W pattern now? And they will start entering from here. I've seen a scenario market came here now and started from here, started falling down. So always wait for market to have a break of market structure. Break of market structure here before you come down to buy, which I already said. Before you actually come down to buy at this level here. Another type of displacement is what? An N candle displacement. This is when market came to our fair value gap zone here. Fair value gap zone created one candle N. And what we use in knowing this our N candle is the last week here, this candle needs break below this week. If this candle here broke below this week now, there's no more N candle. Then the next candle would engulf it. There must be a break of market structure in all these things now. Market will broke it now. And the next thing here is we'll have to wait for market. We don't buy here to come back here now to get the most amount of risk to reward ratio. See, another thing traders used to do and make mistake here is market to create something like this. It will not come down to this zone and to create something like this and start coming. What I normally say is market is creating liquidity to induce people, and you see the next thing is market to come back. These things here are just trend line liquidities that needs to be taken. Market will come, and once you see this, wait patiently. Know that this kind of setups always goes. Market will always come back to this level for you. What you do is get your Fibonacci now. Fib. Don't actually start from here. Don't actually stop here. Move to the highest here now. Price the highest point price have been to get your this your buy to put it at exactly 0.618. Stop loss below this level, 2 pips below this level is, and you target 5 hour. Another type of displacement is like this in candle on, but just the thing here is mark out this low. As far as we can come down, as far as what the body of each of these candles haven't closed below, we are what it is a valid displacement. This one fourth displacement is we saw the first candle, we saw the second candle, we saw the third candle. It didn't break this low here. The last candle engulfed the highest here now. It is what this guy for us, a complete displacement for us. This is an entry signal method. Gets here from here. So let's go back to our entry. Can you see that this thing I'm telling you with this our example? We can see when market broke this level for us here. This was our entry here now. Now this is not our entry, our displacement right here in the market. Can we see that market was started? Let me remove this so you can see. This is our example here. And it started creating those things for us, and it was actually started doing it to get to points the market will know what there will not be liquidity now. People to run the market upwards now. Market will come back because here is the most amount of place liquidity is at, and what market will clear out this what stop losses right here. People buying here, and you the patient trader what will enter and move. So let's take a look at an example like this. So always screw to look for the recent fair value gap. So guys, look at another example of this is when we actually came into this zone, guys. Which type of displacement is this? This is the first displacement we learned. This level here, we get our Fibonacci retracement from the low to the price I've been to. Can you see market always tests that perfect zone? You can get the year this thing is November 2023, 9th November. From here you backtest this US starts. Don't remove anything from the system. Don't try to trade that PC when market breaks once it breaks a fair value gap, it invalidates it. No more what trying to sell. We are moving with the trend of the market. Because if market breaks a fair value gap, it doesn't mean that it have reversed. It means that particular fair value gap now is not valid. Market choose not to respect it. You would go for the next fair value gap. Assuming market broke this fair value gap, I would have the next fair value gap was this one here, right here. Market will come back here and it will retest from here to the upside. So don't remove from this 0.65. Backtest it and make sure you find confidence in the strategy before you apply it to the market. So from here, this is once into the strategy. If the recent price market reacted from there were weeks from that fair value gap, when you start measuring your stop loss level, don't actually start from this fair value gap here. Start from this week right here now. This is 560 75. That is it's 765, something like this. And you don't tend to be greedy here. The market will give you more than that, but just we need a consistent something 5 RR. The market, that's how you become consistent, doing the right things over and over again. I see also right here market will continue moving up or move with a 5 RR. So guys, you finally come to the end of this YouTube video. I want to thank you for making it up to this point in this video. Smash that subscribe button if you really found value in this one. So guys, when we were actually talking in this video, we made mention about what Fibonacci retracement level for this strategy to be complete was achieving Fibonacci level. So that Fibonacci levels are nature's way of arranging stuff for us. They say that these guys can actually be found everywhere in nature. That it can be found in flowers, petals. It can even be found in our face. It's just nature's way of arranging things for us. And in our market is what it helps us to find definite support and resistance level. What's this thing? How can we be able to map this out correctly, and which zone should we pay close attention to? A full strategy on this right here. See you there.